Hello, my name is Julie Ramsey and welcome to term insurance. Some key points in this session is that term insurance is like renting an apartment. Why? Because it's inexpensive. In that apartment, I have a roof over my head, so it provides only one benefit. Well, in term insurance, I have that one benefit. It pays a death benefit. Just like renting an apartment, though, it builds no equity, no cash value. So if I decide that I don't want it anymore, just like I don't want that apartment, there's no equity that's being built up into that contract. It's like renting. It's the simplest form of pure insurance. Why? Because you're just paying for the death benefit. That's it. Why do we call it term insurance? Well, because it lasts for a period of time. And once that period of time is over, that term, the policy then expires. Remember, there are no living benefits in term insurance. You only get the death benefit. But let's clarify. When the insured dies, then the death benefit's paid to the beneficiary. All right, so you're truly buying this coverage for peace of mind. And when the insured passes away, the death benefit goes on to the beneficiary. The premiums stay level for the term of this policy. Let's talk about level term insurance. In level term insurance, the premium and death benefit stay level for the term. After the term, there's no coverage. For example, let's say that you have a 10-year term policy. All right, the premiums stay level for 10 years, the death benefit stays level for 10 years. In our example, we've got a $50,000 death benefit. That death benefit doesn't change. It stays $50,000 for 10 years. Joe Client was 35 years old when he bought this policy. 10 years later, he's 45. So what happens to his coverage at age 45? It expires. The coverage is over. Another policy is decreasing term insurance. All right? Now, in decreasing term insurance, the premium stays level, but look at the death benefit. The death benefit goes down every single year. Take a look. Here's an example. It's a 10-year decreasing term policy. Now, the death benefit starts at $50,000. Joe Client is 35 years old at time of issue. Every year, the death benefit goes down and down and down. And look at year 10. At year 10, then, the policy expires. Why? Because the term is over. Why would somebody want a decreasing term policy? Why does somebody want a decreasing death benefit? Why do they have a death benefit need that's going down? This works really well to coincide with a home mortgage, because as that mortgage balance goes down, you can coincide then that death benefit to pay off the mortgage at any given time. Now, increasing term. Just like it sounds, the premium stays level, but the face amount increases. That death benefit increases. This is for someone who's worried about the cost of living or inflation. $1 this year won't be worth $1 next year. Typically, increasing term is designed as a rider. That means it piggybacks onto another policy. So you can't usually have an increasing term rider on its own as a separate policy. It's typically a rider. Some common features. One common feature of term insurance is renewable term. And it renews at the end of the term. And at the end of the term, there's no evidence of insurability, which means no medical questions. We don't care what your health is. We will renew the contract. Now, think about that. Gosh, what do we have to do then to renew this policy? So we go for a term, right? Say it's a 10-year term. And then we want to go for another 10-year term. Wow, how do we do that? How do we renew it? What happens is this. We won't ask any medical questions. Instead, the premiums are based on the new term. For example, say we have a 10-year term. The death benefit is $500,000. The issue age is, say, it's age 23. So for 10 years, age 23 to 33, the premiums are $800. To renew, all this client has to do is to pay the increased premiums. Why do they increase? Well, this person is getting older. So now we're going from ages 33 to 43, so the premiums go up. That's all we have to do to renew it. Then at age 43, the premiums go up again. So in a renewable term policy, it doesn't matter what the insured's health becomes later on. We will renew the policy. How do we renew it? We just make sure that they pay the increased premium. Now let's bring these 2 points together. I want to be able to compare level term and renewable term. Let's take a look. Both have a death benefit of $50,000. Both have an issue age of age 30. Let's look at the level term. In the level term, it provides term coverage to age 60. So if our client the issue age was 30 and it's termed to age 60, this which is showing coverage then for 30 years. The premiums stay level every single year. Now let's look at the 10-year renewable term. The policy renews every 10 years. Now we said when it renews, there's no underwriting. We don't care what your health is, we will renew it. But what happens to the premiums? They increase every year. So if it's 10-year renewable term, it will probably renew for another 10 years. Which one is more expensive at age 60? Is it the level term or the renewable term? Well, more expensive at age 60 would be the 10-year renewable term. If you keep that for 30 years in this example, it would be more expensive. But which one's more expensive at age 40? If the issue age was 30, 10 years later, which one is more expensive? It would be term to age 60. So you have to ask yourself, why does the insured or this potential client, why do they need this coverage? What are their goals? Do they plan on keeping it short term or is it longer term? Some other common features are the reentry clause. If you have a reentry clause on your term policy, at the end of the term, you can elect to go through underwriting and be asked medical questions. And if the underwriters deem that you're healthy, you're still, healthy just as you were when you originally took out that policy, the premiums will actually be reduced. Another common feature on a term policy is option to convert. If you have a convertible term policy, this means that later on you can convert your term policy to a permanent policy and we won't ask you a single medical question. To recap, term insurance is like renting an apartment. Why do people buy it? Because it's inexpensive. It provides that roof over my head, right? It provides that death benefit. However, it builds no cash value. There's no equity. So if I decide that I want to cancel that term policy, there's no equity, there would be no cash value there. Thanks for joining me.